A mixed week for US dollar and markets in general because there's so many macro talking points right now. Volatility is high and only expect to get higher this week with focus on tariffs and key US inflation data. Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So it was a bit of a mixed week for the US dollar, finishing in very minor negative territory because, at the commence of the open last week, we had this huge wave of volatility in favor of dollar and general safe haven flows, okay, because of the tariffs that are implemented on Canada and Mexico. But then these guys made good progress in terms of the negotiations. So Trump and US administration deciding to postpone those for a month, which then invited that risk appetite. And we saw that the market's hunting to fill those gaps. We would gap to the downside, for example, euro dollar, we saw gaps in CAD currency. So we were pushing for a filling of those gaps because markets will calm down that, look, these tariffs are not coming into play right now. We have been given, some respite, and obviously those have been postponed for 1 month. Now, outside of that, in terms of fundamentals for the dollar last week, obviously a lot of attention is obviously on the labor market data. When you look here, really, this labor market data, in terms of the official government one we're focused on, was bullish, right? Obviously, the amount of jobs was slightly lower than expected, but the previous was revised pretty sharply higher to 307K from 256, which is bullish. Then the average earning jumping up to 0.5%, which is very much inflationary, right? If people get paid more wage, what do you think they're going to be doing? They're going to be going out spending more and stimulating the economy. And then the unemployment rate, this is bullish as well, dropped down to 4%. So we've got less people that are unemployed in this latest reading, which is very, very bullish indeed. And obviously, all of that is inflationary, right? If the labor market's healthy, there's a strong force to be going out of people to be going out spending money. Now, when you look at the dollar here, obviously it's a bit of a mixed finish, right? Obviously just about in negative territory. But ultimately, the structure is still very much to the upside, in my opinion. You can see that quite clearly, on a daily, where we have been printing these higher highs, higher lows, respecting that structure. Obviously, really over the last, I guess, since mid-Jan, we've been in obviously this pullback phase, a bit of consolidation, because markets just trying to digest everything, all these tariffs that are going on. And obviously, at the end of the day, nothing has changed on a fundamental level with the United States because things are inflationary. The US economy is still outperforming versus its peers. When you look at the Eurozone as well, which is suffering, the ECB are consistently cutting rates. They've left the door open to more. They've got a situation of stagflation right now. So it's not a great situation to be in terms of the Eurozone, whereas the US is much more stable, which is why I still see euro dollar as a southbound trend. If we look at the dollar pair here, again, a bit of a weird sort of finish here because of the volatility of the gaps. But ultimately, again, similar to the Dixie, but the flip side to the Dixie, this is on a downward trajectory, and I still see this as a southbound train. Obviously, we've got that period of consolidation right now, but any pullback looked vulnerable to being sold. We came up to a big test here around the 104 region, faced rejections, and obviously we got this move to the downside again. For me, I'd be really interested in the price heading back towards this 250 towards 102.00 area, and this is where, for me, I'd be initiating further shorts. Obviously, it's not financial advice, it's just my opinion, guys, and I would like to see that come down towards parity, around 100.50, in my opinion. But all eyes this week, by the way, guys, so another big week for the dollar because we're going to be focusing on CPI and inflation. As you can see here, generally speaking, expect to pick up on the core number to jump up to 0.3%. The annualized, as we know, has been sticky anyway. That last reading jumped up to 2.9 from, was it 2.7? Yeah. So inflation's still sticky. We know that the labor market's still high. Data's still generally good. We have seen a slight easing as for example, in the GDP numbers, but it's still bullish. Labor market's still bullish. It's still contributing towards people spending, the economy growing, still at a decent pace, and to keep prices of goods and services quite sticky. And I expect that to reflect in these numbers. We've got Powell speaking. Is he going to be, is most certainly going to be grilled and questioned about incoming rate cuts. Let's see if he leaves the door open to that or he pushes back. I would potentially lean on the latter in terms of him pushing back a little bit, in terms of calming markets down. And retail sales expected to see a slight cooling this time round. For me, that would be quite surprising if we do, as I say, given things remain quite strong and economically sound in the United States. So I am in favor of further dollar upside this week. And I would like to still view this potentially as bottoming out here, sort of bottoming out at this psychological 107.50 area. And maybe, maybe a bit of a stretch, but we're bottoming out and potentially forming a big W here. We get that breakout, that challenge these highs. But anyway, let's see. All eyes, of course, on that key US data. Now, GBP, there is a lot of focus on the UK this week because we have key GDP data, which is expected to show pretty much next to no growth, 0.1%. The Bank of England, we had the Bank of England rate decision last week, which we'll get onto in a moment in terms of anyway reaction on the chart. But as I've said to you guys in recent videos, the UK economy there've been clear signs of cooling. It's a situation similar to the Eurozone, just not as extreme. There's a case of stagflation where growth is generally low. Economy's slowing down, but price of goods and services remain pretty damn sticky. And obviously that's a whole nasty beast in itself, because you've got a slowing down economy. People obviously, trying to tighten up their belts and obviously feeling a bit of the squeeze, but then price of goods and services still remain high. The costs are remaining high, but we're slowing down as economy. It's just crappy situation, to be frank, okay, with that language. But Bank of England last week reinforcing what I just said, that there's stagflation. Growth is expect consumers to feel the squeeze in the coming months and this year because of high prices and just slowing down of the economy. And their growth forecasts were downgraded, okay? And they still see sticky inflation, but they have left the door open to more cuts, but they want inflation down, okay? They do want inflation down, but it's just it's a tricky one for them, for any central bank, when we've got stagflation. Now, if you look at GU here, it's a bit of a mixed one, because on the weekly we pulled back after those gaps to the downside. Remember, UK, the reason why GP sort of pulled back quite quickly is because at the end of the day, UK are not directly impacted by tariffs, for example, like Euro or like Canada or Mexico. They're not directly impacted. It's just if, for example, their business partners, the partners that they do trade with, obviously have a slowdown as a result of tariffs, then they may buy less goods from the UK, which affects the UK indirectly. Anyway, pound here, looking, as I say, mixed picture on the weekly when you look. Okay, I'd still take it with a pinch of salt because the fundamentals remain bearish. The dollar fundamentals remain bullish. Here with the UK, with the pound, obviously we topped out at psychological 127. You can see that heavy supply there. But look how many times this zone has been enforced. Bam, bam, bam. Okay, so 125 is big. We formed an evening star, validated by that closure below with this sort of bearish engulfing candlestick and leaving that wick, which we were set to fill there on Friday. It was pushing for that wick fill. And now obviously we have demand at around this 124.00 area, which I'll be looking for a potential breakout retest and leave the door open to some more selling. Go and challenge this key area here at 123. Obviously, if 123 is broken down by the bears, then we're going to have a fast drop down towards 121.50, these lows of January. So all eyes on UK GDP on Thursday. Volatility incoming for CHF, the Swiss franc, because we do have key inflation data, CPI from Switzerland. Now, this is an interesting one right now because obviously the S&B are pretty damn dovish. They've been cutting back to back. And the reason for that is because inflation's been falling, right? Remember, when price of goods and services are coming down, it's obviously a general signal that the economy is slowing down. Because if the economy is slowing down, then price of goods and services are coming down, okay? Because people are naturally just not spending. So, of course, prices of goods and services, these businesses are putting down their prices. So there are fears, and we've seen it on a couple of readings with Switzerland, signs of deflation where we're in negative territory. We saw that at the previous reading, and it's expected to remain in deflation there as well. Now, the S&B chairman did warn of potential negative rates. Why are negative rates being spoken about? They're being spoken about because if we have deflation, Japan introduced negative rates for many, many years. Japan suffered with deflation for many, many years and then introduced negative rates. Now, negative interest rates discourages a couple of things. One, obviously, if people are naturally not spending and prices keep falling, that's deflation, right? So then you get charged. There's a negative rate. So you get charged to leave your money in the bank. So it encourages people to take their money out, okay, and go and spend, try and stimulate the economy, go and buy some stocks, go and use some goods and services, all of that to try and stimulate some spending. So that's why the general reason why negative rates get introduced there. Obviously, from a foreign investor perspective, it's not encouraging for money flows coming in. Okay, because obviously you get the yield's just not great there for a foreign investor. Anyway, that's the fundamentals out of the way. In the technicals, I still like dollar Swiss longs. I like them. Obviously, it's a bit of a weird candlestick on a weekly just because of all that volatility with tariffs and all that. But I like how we've got comfortable here. We've gotten comfortable around this sort of 90.00 area. Okay, we found key support there. You can see that big demand. And we're almost forming a bit of a double bottom, 1, 2, and obviously our neckline up here around 91.50. It's sort of similar to the flip side to what we're observing there in the Dixie. So, well, not the flip side, but the bull case for the Dixie as well. So I'd like to see this, and I still see us working into that next zone, 94s and maybe even towards 1. towards parity. So once again, a week filled with volatility, and things obviously are exciting given Trump coming into play as the US president. Other than that, have an amazing and blessed week, and I'll catch you on the next video.